Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you the day's schedule events for Tuesday, May 10th. Well, much of the important data for today is already out. The China CPI, the German industrial production, and the German trade balance. The next statistic out today is the UK trade data. The visible trade deficit is expected to narrow somewhat, and the overall trade deficit is expected to narrow a bit more, implying that the market thinks the services surplus is likely to rise. Now, that would be good news, but whether it would be good enough to boost sterling is another question. The Bank of England meeting this week will bring another quarterly inflation report with updated economic forecasts. The bank is likely to revise down its forecast, which could lead to sterling weakness. I think it would take a larger improvement in the trade deficit to outweigh that fear in investors' minds. When the U.S. starts up, we'll be waiting for the U.S. wholesale inventories. Now, the market expects a small rise from the previous month. This follows 5 consecutive months of decline. Looking at the relationship between the inventories data and the ISM inventory subindex, there seems to be a big gap recently. The question is whether the gap is filled by the ISM index coming down or the inventories going up. If it's the latter, we could have a positive surprise this time around that would boost the dollar. Next is the JOLTS report, the Job Openings and Labor Turnover Survey. Now, I admit this really isn't much of a market mover, but it's closely watched by the Fed as an indication of labor market conditions. There are 2 numbers to notice: the number of job openings and the separation rate. Separation rate is the percent of people changing jobs. The number of job openings is expected to fall slightly, which would partly explain why the number of people getting jobs is slowing. The separation rate has held pretty steady for over a year now, except for a small blip up in December. This number is important because when people feel more confident about their jobs, they move jobs more frequently. So an increase there would be a good sign that the labor market is still strong and could be positive for the dollar. On the other hand, another figure around 3.5% wouldn't have any impact. Finally, overnight we get the Australian home loans data. The relationship here might not be what you expect. A rise in home loans is associated with a fall in the currency, over time at least. That might be because home loans tend to rise when interest rates fall. In any case, the short-term market reaction is simpler. As usual, when the indicator beats expectations, the Aussie dollar tends to gain. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.